Welcome back. When it comes to the supply chain, the pandemic is still reshaping how the world buys, sells, and ships. Some things we're watching. The Biden administration claiming credit for averting a possible rail strike earlier this week, and FedEx sounding the alarm on costs. For a better picture of all of this encompassing story, let's bring in two guests. Morgan Swink, Executive Director of the Center for Supply Chain Innovation at TCU Neeley School of Business, and John McQuiston, Managing Director at Wells Fargo Trade and Supply Chain Finance. Morgan, I want to start with you here, and thank you both for coming here today. Can you give us a little bit of background on this problem? We know that coming into the pandemic, the just-in-time supply lines were a feature of modern business, and it now seems like maybe they're a bug.
Yeah, well, you put your finger right on it, Jared. For decades, we've been building very tightly synchronized, lean, just-in-time supply chains, global, and that's paid huge dividends for people around the world. But of course, there's a cost to everything, and we haven't really emphasized resilience or flexibility in those supply chains, and so now we're kind of seeing some of the disruptions that can happen when you have these long-linked, tightly synchronized chains. And actually, I'll just add another point. Labor is a huge issue, of course. And we, in the past, were able to use labor. Companies were using labor as a way to flex supply chains up and down pretty quickly. But of course, that's no longer an option given the current labor environment. So that exacerbates the problem.
And John, given what Morgan is saying here, what are some of the solutions? We know that Wall Street and businesses, industrialists can accomplish some pretty big things when they put their heads together. So what are the potential solutions here?
The real solutions are ultimately going to be those of infrastructure investment and a greater resiliency in the physical supply chain. In the meantime, though, there are these supply chain finance programs, whether they're buyer-based or seller-based, that enable companies to extend their working capital cash cycle. And so if you get an extra, call it 6 months before you have to pay your bills, it could be the difference between corporate survival and corporate non-existence. And so these programs actually do help, and they've kept a lot of people in work over the last, I would say, 2.5 years, ever since COVID started. They're quite simple to explain, but it basically allows a buyer more time to pay their bills while paying their suppliers immediately.
And let me just ask you, does this addresses the problem of payment? Actually getting the physical goods a little bit sooner is, of course, a different problem. Wondering if there's any part of this that's addressing that side of the problem, or if you're just concerned with the finance here.
So it's always going to be the physical side that's the most important, clearly. And what you're seeing are innovative things like smaller ports opening up that you haven't seen used before for seaborne shipments. Smaller ports that can't fit the larger ships are now getting smaller ships coming in with containers. So there's been some innovative approaches in terms of how you use the ports, which ports you use. Do you have to be at Long Beach, or can you be somewhere nearby? The challenge is you can't put the same volumes through, so you're still going to have the stress in the system, just as it is today. And that stress will continue. But, if you go into any American retailer or supermarket, it doesn't look terrible right now. But I think if anything happened in rail, things would look very different.
And Morgan, rail strike averted, at least for now. Looks like it bought a little bit of time. What about some of the other transportation methods? For instance, we just got that -4 guidance on FedEx, and just kind of portending maybe things could get a little bit worse before they get better. Just wondering what you're seeing from a bird's eye view here.
Well, the big issue, of course, is alternatives. All right, the companies have alternatives if they can no longer ship by rail. And thankfully, again, it doesn't look like we're going to face that problem. Or FedEx, or whatever the mode is. Do they have alternatives? And unfortunately, we don't have many alternatives right now. Of course, your audience, I'm sure, is very familiar with the shortage of drivers in trucking in general, and that just puts a constraint on everything. So I don't see an easy solution to that. It's going to be a long time before we kind of work our way out of those problems.
All right, so maybe not by Christmas. John, let me throw this to you. We got time for one more. What changes can we expect besides the long-term time frame here? What can we expect in the coming 3 to 6 months, maybe over a year, just in terms of policy initiatives, some of the dialogue that we're hoping to foster here, and then your initiatives on the banking side?
So I'll take the first part of the question first. You would need to see actions on the part of business and government jointly cooperating to solve some of the problems. I'd say avoiding a strike is critical. If there's a railroad strike, you will see empty shelves in many places. You'd start having to prioritize shipping of certain goods that are deemed essential, so pharmaceuticals, food, so forth. And consumer products could be the ones that suffer at the retail level. You also have the industrial sector too, and how do you prioritize that? So how does Chrysler's Jeep factory get their parts if they're coming into Seattle and they can't get them through Seattle? So the effect could be enormous if there were to be a rail strike. And as our friend just mentioned, there aren't enough drivers. I mean, trucking has been suffering from a shortage of drivers for a very long time already. What would I expect to see over Christmas? It depends on if there's a strike in rail or not. The strike in rail could have a very big effect. The banks will continue to offer these programs, and based on certain technological developments, it's much easier to do these programs now for even smaller companies than 10 years ago or even 5 years ago. So the technology has made it possible to bring these programs to ever smaller corporations in terms of size and still have them work for all parties. And I would expect to see a continued emphasis on bringing these products, these supply chain finance tools, to smaller and smaller companies over time. That helps, but it's a short-term panacea. It's not the long-term fix. The long-term fix is always going to be in the physical movement.
Well, it seems like we all got our work cut out for us here. Really appreciate both of you stopping by. John McQuiston, Managing Director at Wells Fargo Trade and Supply Chain Finance, and Morgan Swink, Executive Director for the Center for Supply Chain Innovation at TCU Neeley School of Business. Also, Morgan, you're ringing the closing bell today at the New York Stock Exchange for TCU's 150th anniversary. Congratulations. I've been there a number of times myself. You look great in the background there, so have some fun doing that.